What's a Contra account? See, that's a fancy name, but we have no idea what it really means. And that's okay, we're going to talk about it right now. You see, anytime that you give someone something, there's always a chance they never give it back to you. For example, I once loaned a buddy of mine some scissors and I never got those back. That's why Contra accounts exist. You see, Contra accounts allow companies to express risk facing them on not getting paid. For example, let's say I gave you $100, and in theory, in my accounting world, I would create an accounts receivable for $100. However, let's say that the last time I gave you $100, you only gave me $50 back. Well, if I expect to get $100 back this time, that makes me kind of foolish. So what I do is I create what's called a Contra account. That Contra account is called Allowance for Doubtful Accounts, and it's underneath accounts receivable if it exists. Sometimes they lump them into one and they say this is net accounts receivable, which just means all the money that they loaned out minus how much they don't expect to get back. So my loan to you for that $100, and if I don't expect you to give me back all of it, let's say I expect you to give me back 50 of it, then I'd have accounts receivable at $100, then right underneath that I'd have allowance with doubtful accounts for $50. So my net accounts receivable would then become 100 minus 50 for $50. Now, to think about a big company example, consulting firms. A lot of times, consulting firms actually do work first, then they get paid later on. Now, consulting firms get hired either because one, the company's not doing so well, or two, they're trying to figure out ways to grow. If the company's not doing so well, there's a good chance that they may not actually pay these consulting firms once the work is done because they've gone bankrupt, or they just don't have the money to pay them anymore. So consulting firms have to understand that they need to create an allowance for doubtful accounts. So, if I was a consulting firm and I went out there to do some consulting and I was consulting a company that was on the verge of bankruptcy, I may say, hey, they owe me $100 million in fees, but I may only get to see $20 million of that. See, a Contra account, like allowance for doubtful accounts, allows companies to express risk to their investors. It allows them to actually say, hey, while we did this much in work, we may not get all that money back. Another type of a Contra account is called accumulated depreciation, and it's actually usually tied with what's just called assets or long-term assets. We'll cover that in a little bit. For right now, accumulated depreciation is the opposite of appreciation. And remember, just thinking about normal life, appreciation is when something goes up in value. So depreciation is when something goes down in value. For example, a very common asset that gets depreciated is pretty much a car. The second you drive your car off the lot, it goes down in value. You see, the way that accountants look at assets is they actually record how much you first purchased it at. So let's use an example. Let's say I bought a car for $10,000 10 years ago. On our actual asset balance sheet, it would say car, $10,000. However, I've used that car and I've had it for 10 years. Is my car still worth $10,000? No. Actually, it's probably not worth much at all. So at this point, we have to say, okay, how much is the car really worth and how do I tell my investors and outsiders about that? That's where accumulated depreciation comes in. So, how does it work? Accountants figure out how long a car is supposed to live for. For this example, let's say my car is going to live for 10 years. So I bought it for $10,000. It's going to stay with me for 10 years and be usable. So we just do 10,000 divided by 10. That gives $1,000 per year. That's how much is actually taken out of that account every year and put into accumulated depreciation. So now, at the end of the, let's say, fourth year, the asset account for my car would still say car, $10,000. But accumulated depreciation would be accumulated depreciation, $4,000. That's because I've used my car for 4 years at $1,000 a year. And so now, once you do 10,000 minus 4,000, my car is really, in today's dollars, worth probably about $6,000. And that's because I was using it, and that use actually made the car worth less, but I was able to hopefully use it for profit and make money off the idea of using the car. So, while it may sound complicated, accumulated depreciation is just subtracting how much you've kind of used an asset. And it's really only important for long-term assets, which we'll cover what that long-term means here in a second. For right now, just remember that accumulated depreciation is subtracted away from the asset to tell you what its real value is, or roughly close to it, in today. All in all, just remember this about Contra accounts. 1, they're usually tied to some normal asset, and then 2, There's some way to actually help investors understand the risks or uses of assets over time.